And now for today's program. When the Roundtable series was started many, many years ago by Rob Engel and Mike Rothschild, their vision was the value of bringing academics together with the broader community to the mutual benefit of both. As academics, if we just talk to each other, we can get insular and tied up in the jargon, and it's very important for us to try to translate what the practical implications of our research are, and also to get feedback, share these questions with the community. What questions matter to you, and how can we adjust our research in response to them? And there's nobody that better characterizes that nexus between academics and the practical world than today's speaker. Michael Melvin has a distinguished career both as an academic and as one of the major players on Wall Street. He's the author of the best-selling textbook, International Money and Finance. He's a former editor of the Academic Journal of International Money and Finance. And his academic research has often had a very practical focus, looking at questions like hedging strategies and the carry trade. And he later went to put that academic research into practice as he became a managing director at BlackRock. And now he's back with us. He's currently the executive director of UCSD's Master of Quantitative Finance program, as well as executive director of our Ken Kroner Center for Financial Research. And on top of all that, he's one of the nicest people you'll ever meet. So I'm very happy to welcome Michael Melvin.
All right, thank you. I'm really happy to be here. I see familiar faces out there, which is great. It looks like a fairly friendly audience. And this next speaker for your next roundtable, Kathleen McGarry, she's great. If you can make this, you need to see this. Excuse me, I've heard her speak before, and she's terrific. So what she has to say on this is really fascinating. And she's, one of the foremost experts that you can find. So that's going to be a great event. Can I come?
Absolutely.
Okay, thank you. So yeah, it's one you don't want to miss. And it's interesting. I've made this very unusual move from academia to industry. And
you just click the right here. Sorry.
Okay, thank you. And it's, I was a professor for 20 years, and I used to tell my wife they're going to carry me feet first out of my office. I love being a professor. Never did I think I'd go to industry. But, professors go around and give talks. So one day I was invited to go to give a brown bag lunch talk about my research at Barclays Global Investors, which was world headquartered in San Francisco. So I go there, that's what professors do. They go around and they talk about, give research presentations. And I was doing research, building quantitative models of the foreign exchange market and global equity markets. So they say, come tell us about what you're working on right now. Sure. And I spent the day there talking to different people, went to dinner that night, and the head of this global macro hedge fund said, well, now you spent all day here. Can you imagine working here? I said, yeah, I really can. But before I came, I thought like in the movies, it's all people, trading desk and yelling at each other. And, I thought that's crazy. But these were serious people doing serious research, building, and BGI was a very quantitative place and very academic place. Many of the leaders, like the guy who took me to dinner, were former professors. And so I said, yeah, now they've been here, I could imagine doing this. So a month later, they invited me back to meet the CEO and made me an offer to go in as a very senior level managing director, head of currency hedge funds, head of currency research. And at that time, there were some very large currency hedge funds they were managing. They got much larger after I joined, too big, in fact. But it was crazy because one day I'm sitting in my, academia is kind of a lonely profession. You sit in your office all day, you do your research, and you talk to people maybe at a seminar, or maybe you chat with someone in the hallway. And so I'm going from sitting in my office doing research to managing these giant currency hedge funds and leading research teams. And it was interesting because I had a sense many people in the industry didn't necessarily believe that an academic should be doing this. And I know half my team was in London. I inherited a team from a guy who was before me, and half the team was in London, half the team was in San Francisco. And I wanted to hire a senior person on the London team. So this headhunting firm set up some interviews, and, one person I said, well, we should talk to this guy. I've seen what he's doing. It's really interesting. And he told them, he said, I don't want to interview with him. I'd never worked for an academic. And I thought, man, are you kidding me? But I ran into that. So I think in the industry, many times there's a sense that, we're doing more interesting, useful stuff than the academics are. And so I'm going to talk about that today. And BlackRock bought BGI in 2009, which was a great thing. It would have been a terrible time to be part of a British banking group, 2009. They would have defaulted on all the deferred compensation, and it would have been a mess. So BlackRock comes along, buys us, and it was great. It's a great firm, had a great time working there. And then in 2016, I was happily at BlackRock, and I was moved. By then, I was in the executive group of multi-asset strategy. I was no longer overseeing investment portfolios, but working with teams globally on research issues, building trading signals, portfolio construction stuff. So it was really great for me because I was always a quant. And now I'm working with both quantitative teams and fundamental investors. And as a quant, I had this narrow-minded view that these guys, how do they do this? And then I got to know these people, worked with their teams, and knew all the inner workings of what they did. It was really impressive. So I came away with so much respect for good fundamental investors. So it was a real broadening experience for me. And then in 2016, again, I was very happy at BlackRock. But I always thought I wanted to go back to academia someday. But living in the right, there are many universities, but I was very picky about where I would live. And when I got offered come to La Jolla, UCSD, I thought, wow, La Jolla, UCSD, doesn't get any better than this. Okay, I'm leaving BlackRock. So I go in. I reported to a guy in London at that time. I was in London on June 1st, 2016, walk in his office and say, I'm giving you 2 months notice. I'm going back to academia. And he said, wow. And he said, well, I know you've talked about that in the past. So it was okay. If I'd walked in and said, giving you 2 months notice, I'm going to Morgan Stanley Asset Management, of course, security would have come. I would have been taken out of the building. And that's how we exited people. You don't stay. You can't even go back to your desk if you tell them you're leaving. So people are smart, right? So people would say, I'm giving you notice. I want to spend more time with my family. And so, I'm leaving. But it was great to leave, come back to academia. It's been great here at UCSD. So when I was at BGI and BlackRock, I had been an academic, and I would take my team. I had a team of researchers in both San Francisco and London, and I would take them to academic conferences. And we'd look at the program, and we just, okay, you go here, you go here, you go here, and would go hear people to try and pick up useful things that are works in progress that we might be able to lift and put in our models. And we tested, we would see these great presentations that showed these great investment results. So we'd go back home, we'd build an implementable version of that. It didn't work. There was no money in it. Why not? Because the data weren't lagged appropriately. They'd be using data you don't know yet, looking ahead, peeking ahead. Or they were ignoring transactions cost, and you'd have some model that's trading every day and you can't possibly make money with that. Or the sample period they use was just perfect for their outcome. And when you go look at other periods, it doesn't work. So, that gives you some skepticism about what you see published in academia, but that doesn't mean it's all bad. But now that I'm at UCSD, I've gotten involved in this research center, the Kroner Center for Financial Research, that grew out of work at BlackRock. My biggest clients were biggest institutions in the world. For the currency hedge funds, they were pension funds, central banks, foundations, sovereign wealth funds, governments. So these were my clients. And we would work on issues that we knew they were concerned about. We'd write a white paper, we'd take it to them and say, well, we know you have this problem. We've worked on it, and let us show you what we've got. And by the way, we have the solution for you, because it's a firm, right? We have things to sell. And so the guy who was the head of my group, Ken Kroner, he was a former finance professor before he joined Wells Fargo Nico, which turned into Barclays Global Investors. And we're talking about, why aren't academics working on this pension fund stuff? The retirement problem that society faces, it's huge. Why, academics have the skills. They could really do good work on this and make a big difference to the world. And so when I came here, one day he showed up at my door and said, we used to talk about at BlackRock, why don't we get academics involved in working with pension funds and try and develop better outcomes for their beneficiaries? He said, let's do it. So with his generosity, we started the Kroner Center for Financial Research. And there's a co-executive director, Graham Elliott. Graham, raise your hand, please, sitting there from the economics department. It's a joint effort between the economics department and the Rady School of Management, where I sit. And the mission is bring the power of academic research to generate better retirement outcomes. So we have 3 advisory councils. We have a chief investment officer advisory council with like the GIC from Singapore and CPPIB from Canada and CalSTRS and other pension funds. And then we have an industry advisory council with people from Morgan Stanley and Makita and D.E. Shaw and the like. And then we have an academic advisory council, which is chaired by my colleague Alan Timmerman here at UCSD and other luminaries from the world of economics and finance. And actually, I left one off here. Kathleen McGarry is on our academic advisory council. She cares a lot about retirement outcomes and how you take care of people in the later stages of life, as you'll learn at the next economics roundtable here. So apologies to Kathleen. So what do we work on? Well, we've been going since 2020. And just a quick run through, you can see how the topics change. What do we work on? We work on what the CIOs, pension fund CIOs, tell us they want us to work on. So what's unique about this research center, the typical academic research center on a university campus is somebody endows the center and then the center finds academics and sponsors what they want to work on. Our center is unique because pension fund CIOs determine what we work on. We meet in September, in a week, in fact, this year. They will come together here at UCSD. They will have each submitted their top 3 research wishes. And then we have this list from all of them. And then they debate and discuss and somehow come up with 3 new topics that they want us to support. And so then we take those topics with our academic advisory council. We put out a call for proposals. The proposals come in, they're reviewed, they're ranked, and then we choose the top 3 and we sponsor them for the next year to get the research going. And the topics have changed. The first year, strategic asset allocation. This was a project, really a regime shifting project. I'll talk some more about that, to identify shifts in regime and how the portfolio, to try and automate, in a sense, portfolio rebalancing. Then pension fund allocations to private equity and portfolio risk and return, and diversity and inclusion and portfolio returns. Is there a trade-off? So this last one, what I see with these CIOs, many times they're dealing with a board, and their board is not made up of investors. Their board is made up of working people from their membership. So I remember early in my time at BGI, we had a request to compete for a big mandate from a state pension fund. And they asked that I come. I usually didn't have to go because we had client-facing people, but I went to this and I met with the state pension fund and there's a CIO. And then there was a guy from the facilities staff and teachers and like that. And I thought, wow, this is a $300 million mandate that and they ended up giving it to us instead of whoever else was competing. I think these guys are voting on this. And, I don't know how these things work. And so working with the CIOs, I found many times they need independent evidence because all of the people are trying to sell them stuff, are all trying to pitch things and give them advice, but to have academics do the research. So this project was looking at so-called emerging managers, that emerging managers are pension funds owned by underrepresented minorities. And so there was a push at this time to allocate some of your portfolio to emerging managers. And, you know, as the CIO CalSTRS, a guy named Chris Ailman at that time was chair of our CIO Advisory Council. And he would say, as would the chair of San Diego County, Steve Sexauer, they would say forcefully, we have one mandate: earn returns, pay benefits. We can't do social engineering. So if we're going to allocate to emerging managers, we need some evidence. We're not going to pay a price for that. And so that's what this paper did. Took an emerging manager database, looked at the returns, and showed that, you know, the returns look pretty good and you don't seem to pay a price. Then in 2021, the topics, we started getting ESG requests. By the way, those have all disappeared now. So, but at this time, we were getting ESG requests from the CIO. So we did some papers on activist investing, environmentally sensitive ESG oriented investing. And we have one also on actively managed funds, because as many of you know, that's been an active debate in the pension fund community. Should we just index everything, passive management, low fees, or do we still need active managers? And yes, they still need active managers. Then we had some more ESG investing the next year, and now things have changed. So now we have alternatives, choosing pension fund investment consultants. That's a very sensitive topic. And portfolio design for institutional investors. So things change. And by the way, this alternatives, Graham reminded me that in February, we're having a conference in collaboration with an alternatives group, and it will be focused on alternatives for pension funds. And so love to have local people come to this. There'll be people coming from all over the place, but we would love to have people from San Diego attending as well. And then now we've got benchmarks. There was interest in revisiting the issue of benchmarks for pension funds and private markets as an asset class. So let me return to this topic. You may have doubts about the value of academic research to practitioners, and it's reasonable that you do, because if you look at an academic journal, you look at this and you think, what use is this? Take a top economics or finance journal, and any of you practitioners look through it, you'll say, who cares about this? You know what? And Chris even talked to me recently about something. Yeah. So there is great academic research that has changed the way we do practice in finance. Contributions that have lasted through the years by the giants of the profession. This is my personal view. So if you have doubts about the value of academic research to practitioners, fasten your seatbelts. Here we go. Here are the greatest hits of academic research that we have adopted in industry. So I'm going to start with portfolio selection, 1952 Journal of Finance, Harry Markowitz. So this is started everything, changed the way we do finance. So Harry was here at UCSD. In the winter of 2016, I was trying to decide to leave. Should I leave BlackRock and accept an offer from UCSD or stay at BlackRock? And had I known I'd become friends with Harry Markowitz when I got here, that would have affected my decision. It would have been an additional positive for coming. I came, I got to know Harry, and we became friends. So right after I got here, you know, before COVID, we had meetings in person. And so I was in a conference room. We were having some meeting at the Rady School of Management, and Harry's there. And at the end of the meeting, Harry comes over. We talk for a while. He says, Michael, come have lunch with me next week. So on the Wednesday, next week, I went to lunch. I told my faculty assistant, Rosangela, hey, I'm going to have lunch with Harry at 1 o'clock. I should be back by 3. I had no clue. That's not the way this man worked. I went to his office at 1 o'clock, sat in his office. It was on Turquoise Street in Pacific Beach. We sat in his office. He showed me some of the treasures in his office. And then he said, okay, shall we walk to lunch? I said, sure. We walked to Garnett, an hour walk to a Thai restaurant. We had a nice lunch. Then he said, I like to go for walks after lunch. Do you? And I said, sure, let's go. So we walked for 2 hours. So I left my lunch at 5 o'clock. So that And we talked the whole time because Harry had never thought about currency markets. So he had all these questions about risk management, portfolio construction, trading signals. And so we had such a good time. He said, Michael, let's meet once a month. So once a month, I would meet Harry at Brugger's Bagels on Garnett Street. And he'd be sitting there writing longhand with a yellow pad, working on a 3-volume set of books that he had. And at this time, he was 88 years old, and he's working on volume 2 of his 3-volume edition. And then we'd go walk somewhere for lunch and then go for a long walk. So this went on for years, several years, until he couldn't do it any longer. So Harry's called the father of modern finance, the father of modern portfolio management. This article in 1952 brought covariance, volatility to investing. Before that, it was all expected returns. You build a portfolio by the expected returns on the different stocks, let's say an equity portfolio. And Harry got this idea of, well, I should have volatility, covariance. You care about the risk of the whole portfolio, not just expected returns. And so I asked him at our first meeting, I said, okay, how'd you get this idea for the 1952 paper? And he said, well, I was sitting in the hallway waiting to meet with my dissertation advisor. So this was a guy named Jacob Marshak at the University of Chicago. He was sitting there, and there was another person sitting there waiting to see Marshak. It was his stockbroker. So remember, there was once a world, if you wanted to trade a stock, you had to call somebody or meet with them to have them put in the order for you. There was no online anything. So Harry's sitting there chatting with the stockbroker, and the stockbroker said, what are you doing? He said, well, I'm a PhD student. I'm trying to figure out what I want to work on for my dissertation. And this other fellow says, you should work on investing in the stock market. And so that gave Harry a little spark. And he said, I was in the library later that afternoon. I was browsing the statistics textbooks and was thumbing through it. And I saw this covariance. And I thought, whoa, wait a minute. So that's where the idea came from, that Harry said that's probably the best tip that stockbroker ever gave anyways. So we start with Markowitz. Then we come to the 60s. William Sharpe, Capital Asset Prices, Journal of Finance, 1964. John Lintner, Valuation of Risk Assets, Review of Economics and Statistics, 1965. So this is the capital asset pricing model, alpha and beta. And it's funny, one of my students in the Masters of Quant Finance program went for an interview last year, didn't get the job. I knew the person who interviewed her. I said, well, what happened? Where'd she go wrong? He said, Michael, I asked her, explain the capital asset pricing model to me. What's alpha, what's beta? And she couldn't do it. And I thought, oh my God, they learned that in the first quarter of our program. So, I mean, this is basic stuff, right? So Harry had started this with his 52 paper, but then William Sharpe was a graduate student at UCLA, and his advisor was a guy named J. Fred Weston, who was a finance professor at UCLA. And so Sharpe said to Weston, I want to do something on investing. And so Weston said, there's a guy at the Rand Corporation in Santa Monica, Harry Markowitz. You should go meet with him. So Sharpe met with Harry. Harry worked at the Rand Corporation, which is a think tank, does a lot of government contracting, national defense stuff. Harry's son once told me, I was a little boy and I'd go visit Harry at the Rand Corporation. He said even the garbage cans had combination locks on them. So this was national defense related stuff. And this era at the Rand Corporation is why Harry won the John von Neumann Award for contributions to operations research. Because while he was at the Rand Corporation, he was doing research on sparse matrices and optimization problems with some other very smart people who worked there at the same time. So Sharpe visited Harry. Harry told him what he had done and what he was interested in, and Sharpe went away and developed the capital asset pricing model. Moving on, Fama and French, Common Risk Factors, Returns on Stocks and Bonds, Journal of Financial Economics, 1993. Multi-asset factor pricing. So factor models, size, momentum, value, all these things that we do nowadays grew out of this Fama and French work. And probably many of you have used Ken French's website, where he has this big library of factors. You can download the data and run regressions to get factor loadings on different assets. And others came in this area, like Bar Rosenberg. BARA started as a result of Bar Rosenberg. and would sell factor models, risk models to clients. What time am I supposed to finish? Oh, okay, good. And this Bar Rosenberg, the Barra firm, he was a professor at Berkeley, and Barra was located in Berkeley, California, off campus. The president of Barra, when it was sold to MSCI, was a guy named Old, and Grenold was the head of research at Barclays Global Investors when I was hired, and I reported to him. And he told me, he said, Michael, when I was president and was negotiating with MSCI to sell the firm to them, he said, I had this guy I'd hired at Barra, and when he was a young man, he mowed my lawn. So Richard Grenold had been a professor at Berkeley in finance, and he left that to do Barra full time with Bar Rosenberg. And he said, this guy who mowed my lawn, my goal, when I looked at how we would allocate the payout, I wanted him to take away $1 million from the MSCI deal. So I'm thinking, wow, there's this kid who used to mow your lawn who's going to walk out of here because of the relationship. So, you know, this just really hits home. It really is a relationship-oriented business. And we used to say at BlackRock, be careful how you talk to people because you never know who will be your next boss in your next role. So this was a great lesson. The lawn mowing boy walks away with $1 million from the MSCI deal. Then we have Black-Scholes, the pricing of options and corporate liabilities, Journal of Political Economy, 1973. But everybody's heard of the Black-Scholes model. This is where it comes from and had a huge impact on practice. Still today, people say, well, price this, you know, well, give me an option price on this. They'll use Black-Scholes. Now, of course, there are assumptions in Black-Scholes that are not exactly what you would like. And so there are other models that have grown up over time, but this is still the workhorse, I would assert, of options market. And other people besides Fisher Black and Myron Scholes have worked on, like Merton. These guys won Nobel. If Fisher Black had lived long enough, he would have won a Nobel Prize also, but it's had a huge impact on the industry. Then Jim Hamilton, a new approach to the economic analysis of non-stationary time series on a business cycle, Econometrica, 1989. So our host here today, he introduced Markov switching, state-dependent models for macro-financial time series, regime switching, state-dependent models. And just think of regimes that we have in finance. This has been widely applied in the industry for things like risk on, risk off, interest rates rising, interest rates falling, inflation rising, inflation falling, high inflation regimes, low inflation regimes. When you think of regimes, people have used Hamilton's model, and I know myself, I mean, I was working on something about informed trading and uninformed trading for Fed meetings, like intraday Fed meetings. I don't know if you remember, some of you may be old enough to remember, there was this time that people would say, oh, we could assess what the Fed's going to do by the thickness of Alan Greenspan's briefcase. You know, when he'd go into an FOMC meeting, did he have a big, thick briefcase with lots of information, or was it thin? Thin, oh, nothing's going to happen. Thick, uh-oh, we're looking for something out of the FOMC. So I was using volatility intraday. It's a currency paper, trading currencies intraday, because there was also at this time, there were rumors of leaks from the FOMC that people would attend the meetings. And I presented this paper at UC Santa Cruz on an early stage, and there was a guy there on the faculty at Santa Cruz who had been a big shot at the Fed and would attend the FOMC meetings. And I'm presenting this. He said, oh, yeah, Michael. He said, we kept getting messages, communiques from saying the leaks have to stop. He said, but you get up and go to the bathroom, or you could go to your desk during a meeting. So he said, you know, who knows what goes on when people leave. And this, what did I use? I downloaded the code from Jim Hamilton's website, which MATLAB maybe at that time. Yeah. And I found out lots of other people had done the same thing. So it's had a huge impact on industry. And even, you know, I'm at BlackRock in London. I go around the corner to Deutsche Bank to speak with this head of quantitative analysis there. And so, what are you working on? And of course, they told us because we're their biggest client. So they would show us what they're working on and hopefully get us to trade more with them. So I'm working on this regime switching model. I've got this covariance for a multi-asset portfolio. And I've got the risk on regime, the neutral regime, and the risk off regime. And we're switching, that you estimate the covariance using historical returns, but then you can apply so-called shrinkage to it to, bend things to where you think they should be. And he said, so I'm automatically shifting this multi-asset portfolio, the correlations, which creates the hedging in the portfolio, of course. And I said, well, okay, how'd you do it? He said, well, I took Hamilton's code. And so, I kept running into this. So it's had a huge impact. Then we have Heath, Jarrow, and Morton, bond pricing and the term structure of interest rates. Econometrica, 1992. Term structure modeling, yield curves. So models that construct arbitrage-free yield curves and price interest rate products. So this has gone across the profession. And there are other models that people use, of course, but academia had a huge influence on how we model fixed income markets. Engel, autoregressive conditional heteroscedasticity with estimates of the variance of UK inflation. Econometrica. This introduces the idea that volatility can be correlated over time, and you can construct measures of volatility correlated over time. But Rob Engel was at UCSD at the time this was published. He moved to NYU ultimately, but he won the Nobel, as Harry did, he won the Nobel Prize also with Clive Granger, another UCSD economics professor. And volatility model, these models have spread to different applications like value at risk, portfolio construction, time varying volatility, like trading variance swaps. How do you forecast the volatility to make decisions on trading variance swaps, trading volatility? And lots of UCSD PhD students worked in this area, including that guy, Ken Kroner, who founded the Kroner Center for Financial Research here at UCSD. Okay, then Fama, Fisher, Jensen, and Roll, the adjustment of stock prices to new information, International Economic Review, 1969. This is where we get the event study methodology that we use. So some firm has news, earnings release or whatever, and we say, well, what's the impact of that? So we look at observations before the release, observations after the release, and this had a big impact on how we do research in the industry. And so this was a group. Fama, Jensen Roll was a student at University of Chicago. He was also on my dissertation committee, so it's a really smart guy. Then Cost of Transacting by Harold Dimsetz, 1968 Quarterly Journal of Economics, and Hans Stoll, 1976, Dealer Inventory Behavior, Journal of Financial and Quantitative Analysis. These were the very early papers in market microstructure research. And there were many that followed that. Now, instead of looking at things daily or weekly or monthly, looking intraday. And so this kind of research had a huge impact on finance practice as we got the ability to trade intraday. We didn't have that for a long time. But as technology improved, information flows improved, people started trading intradaily, they started executing algorithmically. So the academic research on market microstructure had a big impact on the industry. I know when I moved to Barclays Global Investors, I got there and there was this guy there, Ananth Madhavan, who had been a professor at the Wharton School in finance. And Ananth moved and then he went to USC, I think, and then he got hired by BGI. And he was building models to forecast trade cost. And so you'd use that for pre-trade analysis. Nobody had this kind of stuff, but they had hired this academic who was doing this state-of-the-art microstructure research. And I get there, and like second week I'm there, he says, Michael, I want to show you, I'm working on currency markets. So he shows me what they had done for equity markets and said, now I want to build pre-trade analytics for currency markets. And so we started estimating the spreads that we would get quoted by our counterparties, the cost of doing a trade, depending on the size of the trade. And so we started saving all of our trade data so we could build out these models. And it happened because we hired this former academic who had great skills and who knew very well the academic literature on market microstructure. Then, okay, now I'm moving away from like smaller ideas for implementing particular concepts for portfolio construction to just the way we think about the world as a whole. FAMA, Efficient Capital Markets, Journal of Finance, 1970. Efficient markets, if you were a finance student in the 70s, you were taught that price is where it should be. The price is right. It reflects all the information that we have. And so this hit a peak in the late 70s where, don't worry about trying to forecast prices and trade. So the price is where it should be. If it wasn't, somebody would trade and make it go there. So this had a huge influence, this article. I would argue maybe too much influence, and later that changed, of course. But by the late 70s, this efficient markets, hardcore efficient markets view was the prevailing view in academic finance and filtered somewhat into industry, because think of the implications for how you would trade and how you would build portfolios. Why would I have an active manager and pay for that? They don't know any better than anybody else. And, that active management, I think, was viewed fairly negatively as a result. But time passes. We have Kahneman and Tversky, 1979, Econometrica, prospect theory. And this prospect theory, the beginnings of behavioral finance. Now the world changes. And I have Harry Markowitz, 1952, The Utility of Wealth, because I was once on one of these post-lunch walks with Harry, and some behavioral topic came up, and he stopped. He says, Michael, do you know I'm the grandfather of behavioral finance? And I just smiled. I said, no, Harry, I didn't know that. And, then we started talking about something else. And then later I found out what he meant, that there was a book called Thinking Fast and Slow that Kahneman published a few years ago, I don't know, maybe 10 years ago. And in this book, he explains how they came up with this prospect theory of decision-making under risk. And he said he and Tversky were meeting one day trying to work out the prospect theory, but their theory at that time was based on states of your wealth. And they said, well, if we have experiments using humans and we have them, in trading, fake trading, simulated trading situations, and we give them a few dollars, that doesn't really change their wealth. So are those really relevant? And then he said, Tversky said, well, I remember there's this article by this guy, Harry Markowitz, called the Utility, what was it called? Utility of Wealth, that was published in the Journal of Political Economy in 1952. And Markowitz, his model has changes in wealth. That utility is a function not of your state or your level of wealth, but changes in wealth. So he said, we talked about that and we said, that's the way to go. We're going to develop our prospect theory in terms of gains and losses, not your state of wealth. So this is what Harry meant when he told me I'm the grandfather of behavioral finance. His 1952 paper, which hadn't gotten much attention until Kahneman and Tversky used it to build the prospect theory model. And now efficient markets has been hammered. We know there are all sorts of anomalies that you can't explain by, the market's price is where it's supposed to be. Price isn't always where it's supposed to be. And so this idea of prospect theory, that humans have a big sensitivity to loss aversion, and we make decisions with regard to some reference point, like your current wealth or your aspirational wealth. So why do people buy lottery tickets and at the same time buy insurance? Well, if their wealth is below their aspirational level or where they think it should be, they buy the lottery ticket because they overestimate the probability of winning. By the way, I heard on the radio last night when I was driving home that the lottery was like $1.3 billion, the Powerball. Did anybody win last night? $1.3 billion. So yeah, Kahneman and Tversky say people, those long lines you see, all those people are overestimating the probability they will win, but that's because they're making decisions with regard to some reference point, like their current wealth or their aspirational wealth. So it's had a huge impact on how people trade, and there have been many others who have had important contributions to behavioral finance. And what do we do as a result? Lessons of behavioral finance. We auto-enroll employees in 401k plans. rather than let them decide. We do things like dollar cost averaging, tell people, don't try and time the market. Just put your $50 a month into your portfolio and buy, and that's the best you can do. We put guardrails on portfolio rebalances and try to stop people from panic trading. And even people that are super smart. I have a colleague at BlackRock in San Francisco that really smart lady. She has a PhD in mathematics from Stanford. Her husband's a Fields Medal winner, math professor at Berkeley. And I think, what do they talk about at dinner? So she calls, she's friends with my wife. They're both from Germany. And she calls and she's doing stuff. She's doing advanced optimization stuff at BlackRock for, portfolio rebalances in fancy ways. And so, the stock market collapses, like when COVID hits and the stock market drops dramatically. She's texting Bettina, shall I sell? It's going to get worse. Shall I sell? And so Bettina asked me, what should she do? I said, nothing. She should do nothing. Sit tight. It'll come back. But even super smart people, we're all subject to these behavioral biases. So pension funds definitely have taken that into consideration. Think of glide path retirement funds, like automatically will adjust your portfolio shares as you age, get you into the lower risk portfolio when you're old, have you in the high risk portfolio when you're young, and communications with members. I know as a member of this UC investment plan, as a professor here at UCSD, probably once a month I get something, attend this seminar. There are other UCSD professors sitting here. Attend this seminar, and it's by the UC investment staff in Oakland, just telling people basically dollar cost averaging. Don't change your portfolio, wait, and giving advice on what you should do. So you have doubts about the value of academic research to practitioners? I hope not at this point, because while it's true, there's a lot of marginal, unimportant stuff published in academic journals. Absolutely. And, when you're as old as I am and you've seen this for so long, you realize the way to really build your career as an academic is just harness yourself to some popular theme where, important people, academics, journal editors, they're working in that area, just publish in that area, make little contributions, and you get published. If you try to do something that's really path breaking, it can be very hard to get published. So, there's no saying science progresses one death at a time. So you get these old guys out of the way, and then the new paradigms tend to flourish. But while the old guys are there, if you're not working in what they think is important, you're not doing important work. So that happens a lot in academia. So even with all of that, there have been home runs. The home runs that have affected the way we do business in finance, the way we manage our portfolios, and these have benefited the portfolio managers, but society as a whole. So there will be more home runs in the future, more difference-making research. So out of all of these, say the noise of all the publications in economics and finance, there will be some nuggets that come up, and we will adopt them when they appear. So with that, I conclude.
Thanks so much for those wonderful insights. We have a roving microphone today. And if you would, please wait until you get the microphone so that everybody here and everybody online can hear you. And Michael will let you call on people, or Jay hand the phone.
By the way, Tom used to work with Harry Markowitz. His guided choice. Harry was one of the founders with Sherry, right?
That's right. 2000.
Yeah.
New Year's Day 2000.
Yes.
Anyway, great talk. Thank you very much for this. I have a question pertaining to the getting window that both marketing forces and maybe even the administration are open to, if not encouraging, alternatives, namely private investments, be included in defined contribution lineups, especially tiny units. And I noticed in some of the papers you cite, there seem to be some sanguine inferences about the role of privates, at least in defined benefit plans, I assume. I'm concerned about adverse selection, conflicts of interest, and so on. What private equity fund worth investing in is going to open itself up to our contribution plans? That's kind of my rhetorical question, but I'm curious what you think about this.
Yeah, I'm concerned also because, as you say, if you're not a giant pension fund, you don't have access to the best private equity managers because, you know, the best private equity managers, they want you to tie up your money for a long time, and they're not looking for a $10 million investment, right? They're looking for hundreds of millions. So the giants of the pension fund industry, they have the access to the best managers. The smaller pension funds, which manage billions, but they don't have access. And one of our papers that we sponsored at the Kroner Center by Alan Timmerman got a great database, which we helped them acquire, he and his colleagues on that project. They show this and they document this, how performance differs in like PE returns for big funds versus small funds. So if a small pension fund, say $10 billion pension fund, doesn't have access, what are we as individuals going to have access to? I completely agree, Tom. I think it's, and then to add something like cryptocurrencies to a 401k plan, I'm thinking with the volatility of this, that doesn't belong in anyone's pension plan. So, you know, maybe if you're going to manage your own money and you want to put 5% or something in Bitcoin, okay, that's fine. But to put serious money in a 401k plan with the volatility that cryptocurrencies have, I worry also. So great question. So I agree. I don't think it's wise. And, you know, you remind me, look at you. Here's Harry working with Guided Choice. Harry taught into his 90s. You know, I hope someday I'm teaching in my 90s. So actually, no, I don't. So I think, but Harry taught, and when he was 91, when he was 92, he came out of class one day and he says, Michael, I'm done. This is my last time. I said, what, Harry? He said, I fell asleep during my lecture. Okay. When he was 91, he gave me a document, the plan for his next 10 years. He's 91 years old. Plan for his next 10 years in terms of what he wanted to teach and what he was going to work on. And I thought, wow, I've got this sitting on top of the cabinet in my office. So to remind me of that, 91-year-old Harry's next 10 years. Next question, please. Yes, I think she's next.
Baby boomers, we're seeing them retiring, but wealth accumulation, the transfer of wealth, those have not. Influences in financial markets and investing, given demographics, you know.
Yeah, certainly there is research in that area. The comment I made at the start was like, this is my personal list. So these are the things that have affected what I did and what I do now as an academic researcher. But you point out there are other areas that I didn't talk about that like demographics and how changing demographics should change like returns on assets and the risk that people take. So that's absolutely very important. And like in the world of corporate finance, there have been academic contributions that have had a big impact on how we manage things. So there's certainly other areas that I didn't touch on. Thank you for pointing that out. This is not an all-inclusive list. This is Michael Melvin's personal list of his favorite hits. Yeah, it's just like my taste in music is idiosyncratic. So maybe my taste in the greatest hits of economics and finance is a bit idiosyncratic.
Thanks. So you gave us a lot of examples of hits, pieces of research that turned out to be really important over time. What do you think might be a current or recent example that we might not know about, but you think, this could be a home run?
Wow, that's a tough question. It's also a sensitive question in a sense. So I don't really have one. I mean, there's a lot of work going on, and I'll go to seminars at the Rady School, finance seminars, and I'll hear stuff. I think, well, that's really interesting. And so I think uh, the work in alternatives, I think, has been very useful. And like private equity is, to me, a weird area, right? Because you get these quarterly returns, but they're holding everything. So, you realize your gains when you exit the portfolio, you go IPO or sell it to somebody else. Think, where's these returns come from? And, how's this stuff made up? And so I think, to me, the academic work on private equity, I think, is very useful. And I don't think it even serves as enough of a caution to getting into this space. And of course, now it's run into more difficult times because interest rates aren't near zero anymore, and it's a much tougher business. But that's that's one example that comes to mind. You're Denali, right?
That's right.
Are you guys still Denali, or did you change to McKinley? Or
Still did not.
okay, great, thank you. Yes.
Hard to day passes when you don't hear or read something about the pros and cons of our considered how AI will affect the future of acting.
Wow, I think, yeah, like I was having dinner, my wife and I were having dinner in Berkeley with this fellow who's the math professor at Berkeley, the Fields Medal winner, which is like the Nobel Prize equivalent for mathematics. And he's saying, Michael, I think these AI tools may make me obsolete. So I don't know that what I do is going to be needed anymore. So I don't believe that's true, but I think there's so many things that AI it's already having a huge influence, right? There are people that have been replaced. I think of the different areas at BlackRock, and I was thinking about who can be replaced. Well, we would have people on the client facing group who every month they would spend all this time developing attribution reports to our clients, like, or quarterly. Here's the quarterly report on the portfolio. Here's what happened in the market. I'm thinking they can all be, well, one of them can stay and manage the process, but you feed the data into the LLM and it can write these reports for you. And the writing is really good. I'm getting the best written reports from my students ever. They are great. I mean, and my specialty is international finance. So I've always worked with international students. And just imagine, English isn't your first language. And here you are at UCSD, and you have to write this technical paper in good English. And I understand the challenges that my international students face. So you turn back the clock 5-6 years ago, the writing was really rough. And so I'd have someone who would, like an editor, a communications mentor, read their reports and edit them before we would share them with the firms we were collaborating with. That's not necessary anymore, really, except at a small margin, because it's had a huge impact on our ability to communicate. So, but that said, like at BlackRock, there's an artificial intelligence group of BlackRock in Palo Alto now, just right off the Stanford campus. And they're doing all this high-tech stuff in AI, but you need a finance person working with them, because these are data scientists, computer science people. They're not finance people. So you need a finance person working with them to make sure they stay on track and you get implementable results. So I think it will replace what some people do, but it will allow other people to probably be a whole lot more productive in the area. So, and I don't think we know yet. I think it's changing so rapidly, but my fear is that it's kind of overblown and it's not going to replace as many jobs as people have forecasted. And I may be wrong, but think about wealth management. I bet who's in wealth management here? CFA Society is full of wealth managers. Yeah, you're not going to be replaced. I was the BlackRock representative at CEPR, the Stanford Institute of Economic Policy Research. So I go to meetings there. And one meeting, the CEO of Wealthfront, which is a robo-advisor, he was there and he said, look, we're engineers. We don't like salespeople. We don't have any. So we don't have any humans talking to our clients. We just have machines. And I said, well, yeah, but at that point, since they launched, stock market was going up, up, up. I said, you've been riding a big wave here. When the market turns down, your clients are going to want to talk to a human. They're going to want someone to hold their hand and help them through this time. And he said, no, not our clients. He said, Yeah, right. So I believe wealth management, that's an area of finance that's always going to have humans, because when you're asking someone to manage a lot of money, you want someone to talk with, someone that you will be sure will reflect your preferences and your concerns.
Thank you for the presentation. I remember in the discussion during your presentation about pension fund allocation, you mentioned that we use a 401k as sort of a way to smooth over individual biases towards panic selling or otherwise short horizon activity, and such as your story as asking to sell during the COVID pop. And I was wondering what the role of tail hedging would be in allocation of pension fund management, because I remember back in 2008, or I read about this later on, that CalPERS was having a bit of a discussion over whether to maintain a tail hedge position leading up to the Great Recession. So I was wondering what your thoughts on the role of tail hedging would be in the future of pension funds.
I'm sorry, the role of what exactly?
Tail fund hedge or tail hedging.
Tail
So it'd
hedging
be like
in a pension fund portfolio. Yeah. Well, I think there have been some real lessons learned with that, because I know a fellow in Newport Beach who's got a fund that's a tail risk management fund. So in fact, the name of his firm is Long Tail Asset Management. So that's the name. And what they do, they take options positions, they take positions that pay off when the stock market collapses on the risk off period. So I think, but the problem with that is, and I know a big pension fund that was invested with him, but when the stock market collapse doesn't happen, you pay a price every month, right? So you're buying insurance. You pay, and then you say, no, we don't want you anymore. And then the market collapses and you miss the payoff. If you're going to do it, you commit to it and stay in there till you get that payoff, because there will be market collapses, but insurance costs, right? So you have to pay for it. But I do believe there's a place for tail risk management in pension funds, because they have to keep paying every month. They're beneficiaries, and you can't say, well, the portfolio shrunk. We'll pay you in a few months when it recovers. So I think there is a role for that. Thank you.
Thanks so much for that fantastic presentation. And as Michael said, Kathleen McGarry on November 10th, Long-Term Elderly is going to be another don't miss event. So hope to see you all then.